what's going on, everybody? It is Monday, October 4th. I just sent out the new edition, the new issue of MMT Trader. If you want to copy that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. So we had a pullback in the market today. NASDAQ, S&P, Dow. Last week I told you to sell into the rallies. So here's the scenario. And I think I summed it up on Friday when we had, last week, Thursday, was the end of the fiscal year, September 30th. So 7.74 trillion of total spending. That is a record. 2.91 trillion was the fiscal deficit. That is a nominal record. It was about 12.8% of GDP. That's not a record. I think in 1941, we got up to about 34% of GDP. That would be like almost a 7 trillion. That would be like a 7 trillion deficit right now. So, 2.91 trillion, the way I always explain it to you is that equates to a net transfer to the non-government. It adds 2.91 trillion to the financial balances for us. I mean, domestically and the rest of the world. So that's good. One thing that is a little bit concerning is that we saw a surge in tax flows, okay? And luckily, the spending has outpaced the tax flows. So, here's the thing I always say about taxes, because as soon as you hear about taxes, everybody's all like, whoa, The thing you have to consider when you talk about taxes is what is the net result? In other words, yeah, the government's always going to tax. We know that. But if it spends more than it taxes, then the money is pumped right back into, the economy. And really the discussion is how it is distributed. So if you're going to raise taxes, but at the same time you're going to raise spending, what happens is you might see a kind of a recomposition of the economy in terms of where the income is flowing to, right? Like now, if they're talking about raising taxes on high income earners, but at the same time, they're going to be increasing spending on, let's say working people or social supports or something like that, you're going to have a shift in the economy more towards, I think a broader base as opposed to people who are high income earners. So what I'm trying to say, look, I'm not trying to be political here. I'm not trying to make a state. Look, I pay a lot of tax. I live in New York City. I pay state tax. I pay federal tax. I pay city tax. So don't come after me if I'm talking about taxes, because I probably pay more taxes, at least percentage wise, than most of you out there. All I'm saying is that the way to look at it is the net. Now, let me just add, if the government is taxing more than it's spending, that's bad, okay? That's bad for everybody, because that is sucking out that income, that's draining the swimming pool. And, actually that's exactly what Clinton did in his second term. And that led to a really big recession. And actually it took all the way until the great financial crisis of 2008, 2009 for the damage to be undone. And the damage was undone by large fiscal deficits. And really, you could almost make a case that the damage from the Clinton surpluses, because that's when the government taxes more than it spends, right? It's a surplus in the government's balance. It's a deficit in our balance. You could almost argue that it took all the way until the pandemic to really replace. Because if you look at personal savings, it really just went up to record levels when the pandemic hit. And that was because of the massive fiscal response. So here's the thing. We ended up the fiscal year with daily net flows of around 20 billion, 21 billion. Now that's low, okay? That ended the fiscal year at the lowest flow for the entire fiscal year. I mean, if you just go back to August, we were doing something like 33, 34, 35 billion a day. Okay? So I mean, you know, that's a significant reduction. All right? If that continues, you know, the market's going to come down. The economy is going to enter into a slower growth trajectory. We're going to correct a good portion of, let's call it the pandemic bull market, right? Which reflects massive amounts of stimulus. But then, you know, we'll settle into an, you know, we'll hit some new equilibrium level that reflects the reality of like a 3% to a 3.5% GDP growth rate as opposed to like a 6.5% GDP growth rate. The risk, and now, so that's, I would say that's 70% my outlook. Like, this is a correction. The economy is not really in trouble. We're ratcheting down to a slower growth rate. That means slower growth in corporate profits. That means you're going to see some, you know, revisions of corporate profits and the outlook, the forward outlook companies. As a matter of fact, that's happening. I think you have like, I don't know if it's a record number of downward revisions, but it's very high right now, what's going on. But that's okay. I mean, we'll get a correction. We'll you know, stabilize at some level that reflects a 3%, 3.5% growth rate. I would say the risk, let's say that's my 30% other scenario. So 70% is just a normal correction reflecting a slowdown in the growth rate, but we're not going into a recession or anything like that. The other scenario, the 30% scenario, maybe it's even a 20% scenario, is that the debt ceiling, when we hit that red line that Yellen was talking about, you know, October 18th, when basically Yellen's going to have to choose, you know, who gets paid, who doesn't get paid. That's going to cause, I think, another reduction in those daily flows, maybe fairly consequential, and then we're going to drop down. I think we could drop down, if that happens, we could drop down close to, you know, 1% or less on a GDP growth rate. I don't think the stock market is factoring that in at all. Now, I put that as a pretty low percentage, maybe 20%. Now, somebody alerted me to the fact that the Fed kind of has a contingency plan for a default, where it's not going to allow a default, whereby it will take, let's see how I explain this. The Fed said it will take delinquent treasuries as collateral. If I get this right, it's going to take delinquent treasuries as collateral and then make payments against that. In other words, the Fed kind of becomes a de facto fiscal authority, making loans, where those loans would constitute payments to keep the payments going, the normal government payments going, using delinquent treasuries as collateral. Now, I guess that assumes that you're lucky enough, or unlucky enough, I don't know, maybe unlucky, that's the word, that you hold these delinquent treasuries that you can present as collateral. I don't know what institutions or what entities are going to be allowed to do that. So that's kind of like up in the air. We'll see what happens. But if the Fed can step in and do that and kind of, you know, bridge the gap, so to speak, until all this political bullshit is worked out, and really, it gets me so mad and really, really angry at what's going on. I mean, clown show, man. But if the Fed could do that, and by the way, if that happens and that removes the risk of default, which I think is a factor right now in bond yields, then I think bond yields are going to drop substantially. By the way, if you get my report today, I mean, there's some incredible contrarian positioning going on in the futures markets Like if you're looking at what's going on in bond, I checked it out, bonds, gold, oil, the dollar. I mean, there's some historic contrary positioning going on. I'm talking about what commercials are doing vis-a-vis what speculators are doing. Like really, I mean, if the commercials are right on this, there's going to be some big and very surprising moves. Anyway, that's it for today, folks. Go to my website, pitbulleconomics.com, sign up, and see you tomorrow. Bye.